Hello and welcome back to Passive Pulse series, where we discuss passive funds and ETFs. In today's episode, we'll talk about smart beta indices. So let's begin the journey into the world of passive investing only with Passive Pulse. And joining me now is Mr. Arun Sundaresan. He's head ETF at Nippon India Mutual Fund. Welcome back, Arun.
Thank you, Gitu. Thanks for having me on the show.
My pleasure, sir. Let's start with smart beta indices. What exactly are smart beta indices? Are they smart enough to protect your portfolios?
So, smart beta is a colloquially used terminology. I must tell you that.
Mhm,
Uh, there are essentially four types of indices. So, one is broad market index, like your Nifty, mid cap, small cap.
mhm,
All these are essentially market cap based indices,
mhm.
and investors understand them quite well. The
Right.
second type of indices are sectoral indices, like
Mhm,
uh, a bank index, IT index, pharmaceuticals, auto.
mhm,
So they focus on a specific sector. So they are the second type of indices.
mhm,
The third is called thematic. So it's
mhm.
not a particular sector, but a theme. Like, for example, if you take consumption, right? The consumption can come across different sectors, right? The entire
Right.
spectrum, it can be FMCG, it can be
Mhm,
consumer durables, paint companies, so many, it can come from different sectors. But here we are talking about a theme called consumption. Likewise, that
mhm,
can be infrastructure, manufacturing, all these are
mhm,
themes. Now,
mhm,
the fourth one, which is what colloquially called as smart beta, and I'll tell
mhm,
you why they are called smart beta, and we can figure
mhm,
out whether they are smart.
mhm.
Uh, they are technically called as strategy indices
Okay.
or factor indices. Um,
Mhm,
so there are these various factors like value, momentum,
mhm,
quality, low volatility, and these kind of factors, which actually focus on specific aspects of the market, and by focusing on that, can they
mhm,
generate better return than market? So that's the concept of these strategy indices or smart beta products.
mhm,
So why are they probably called smart beta?
mhm.
Generally, the term beta is associated with market risk. So market returns or market risk. So that is what is called beta. So
Mhm,
essentially, when you say market, you're referring
mhm,
to broad market index like Nifty Sensex. So today you
mhm,
say that market is down. What do you
mhm.
mean? You actually mean that perhaps Nifty is down, Sensex is
Right.
down, right? So
Mhm,
that
mhm,
is called as beta. You get market return. If
mhm.
there is a potential to get more return than that by doing some
Okay.
variation
Okay.
of those indices, then
Mhm,
potentially they become smart beta or strategy
mhm,
indices. So that
mhm,
is what they are all about.
mhm,
So basically, you take a broad market index. It could be
mhm,
a mid cap, it could be BSE 100, or any of
mhm,
these broad market index. You
mhm.
apply certain rules and do a variation on them. Suppose
Right.
it is a value factor that you want to focus on. You take
Okay.
Nifty 50, apply
Mhm,
certain value filters, and pick
mhm,
up, let's say, 20 stocks. Then it becomes a very different strategy from Nifty, a
mhm.
strategy which is focused on value. And then you
Okay.
have a strategy index or a smart beta
Mhm,
strategy in front of you. So
mhm,
that's essentially what these indices are.
mhm, mhm. You said these are based on some indicators or the factors that take you guys take into consideration before getting into the smart beta indices fund. So, what are these key factors? You spoke about value. Is that the only factor, or there are other factors also on which the stocks are evaluated?
No, there are almost eight different factors of
Mhm,
value, quality,
mhm,
momentum,
mhm,
alpha, even
mhm.
size is a factor. Like, for example,
Okay.
Nifty and mid cap, all these broad market indices, they are
Mhm,
based on market cap, which means that the largest stock gets the highest weight, and then the
mhm,
weight keep reducing. The weight will actually depend on the size, right?
mhm,
So on the other hand, you take that Nifty 50 or Nifty 500, And if you
Mm-hmm.
say that I will not give weightage as per market cap, but I'll give
Mm-hmm.
equal weight, then
Mm-hmm.
that itself is a variation on the
Okay.
broad market index. So it becomes a factor. So in this
Mm-hmm.
case, size is a factor, alpha
Mm-hmm.
is a factor,
Okay.
dividend yield or dividend opportunities is a factor. So you
Mm-hmm.
have all these different types of factors or strategies.
Mm-hmm.
And then the interesting part is you can take any of these factors and
Mm-hmm.
apply on any part of the market. Like, for
Okay.
example, a
Mm-hmm.
value strategy can be applied only on large cap, then you have a strategy.
Okay.
Likewise, you can take value and apply it on Nifty 500 on the entire market. Then you will have a
Okay.
very, very different index and a different
Right.
product, different index with
Mm-hmm.
a risk return profile, which is very, very different, even though it's
Mm-hmm.
value, but it is
Mm-hmm.
applied on a different part of the market. So then have variations like that. You can
Mm-hmm.
also do multi-factor strategies.
Okay.
Like, for example, alpha is a factor, low
Mm-hmm.
volatility is a factor. You
Okay.
can create an index which will combine both alpha and low volatility. And
Okay.
that becomes another strategy in itself. So
Mm-hmm.
likewise, when you say you have 7, 8 different factors, you have
Mm-hmm.
the large cap, mid cap, small cap, or the entire market, and then you
Mm-hmm.
can do multi-factors, two-factor
Yeah.
models, three-factor models. You can
Mm-hmm.
imagine the permutation and combination of
Mm-hmm.
the various strategies that can be possible,
Mm-hmm.
which is what makes the space also very, very interesting. So
Mm-hmm.
depending on your actual requirement and risk return appetite,
Mm-hmm.
there are enormous opportunities, different types of the smart beta or factor
Mm-hmm.
indices, uh,
Mm-hmm.
which which incidentally are not available on the I must say maybe few, but
Mm-hmm.
on the actively managed mutual fund space. These are
Okay.
largely available on the passive side on
Mm-hmm.
both ETF as well as index fund format
Mm-hmm.
because there is a particular index, there is a rule, and you simply
Mm-hmm.
have to replicate it. And they
Mm-hmm.
also undergo frequent change when
Mm-hmm.
the stocks change, and then it gets to be replicated. So
Mm-hmm.
you will not find too many of these in the actively managed mutual fund space, but
Okay.
you get them in the passive side.
Mm-hmm. So I get that it can be a single factor also, and it can be a combination of factors also for selecting the stocks for smart beta index fund. So how is it different from the traditional way of investing?
So traditional way of investing, and if you're talking about active funds, where a fund manager and a
Mm-hmm.
team of analysts and his team actually takes decisions as to
Mm-hmm.
what stocks to buy, what weightages to give. It is
Mm-hmm.
in a way view based, a lot of
Mm-hmm.
perspectives, a qualitative assessment. They do look
Mm-hmm.
at a lot of quantitative numbers,
Mm-hmm.
how the company is performing,
Mm-hmm.
fundamentally how is it doing, and so on and so forth. They also
Mm-hmm.
bring in a lot of qualitative assessment as to
Mm-hmm.
how they expect this particular company to do well
Mm-hmm.
in the markets, and therefore
Mm-hmm.
they make investment decisions based on that.
Mm-hmm.
Against this, the passive approach, that's the fundamental difference between active investing and passive, is that there is a
Mm-hmm.
particular index which is governed by a set of rules that is
Okay.
known. For
Mm-hmm.
example, what is the definition of value? You will know
Mm-hmm.
that, okay, these are the parameters considered. The
Mm-hmm.
weightages given to these parameters are this. The rebalancing frequency is like this. And the index will simply follow that rule. And
Mm-hmm.
if it is undergoing a change every year or every 6 months, for example, based on
Mm-hmm.
that, regardless of what type of stock it is, there could be a stock, which in the market could have a 10, 11% kind of weight because of its
Mm-hmm.
sheer size. But
Mm-hmm.
according to this rule, if it is
Mm-hmm.
not ticking the box, even that large stock may not be in the portfolio. So it's very
Okay.
dynamic. It completely follows the rule, and based on that, your portfolio could be very, very different. So that's
Mm-hmm.
essentially the difference. Both approaches have their own merits.
Mm-hmm.
They also have their own shortcomings.
Mm-hmm.
But when it comes to passive investing, because you know the rules and
Mm-hmm.
it's very transparent, So you can expect a fund to be true to label, meaning you're choosing, let's say, a value or a
Mhm.
momentum or any
Mhm.
particular strategy. You know exactly what you're getting into. To that extent,
Right.
you can be very sure. When it comes to active management, the approach could be something to start with. Over a period of time, those things could change based
Mhm.
on the fund manager's perspective, and
Mhm.
depending on that, it could work sometime, it may not. So that's the essential difference between the two.
Mhm. There's a perception, Arun, that multi-factor beta funds outperform single factor ones. Is that true?
No, not really.
Mhm.
You actually need to look at what those factors are. For
Mhm.
example, I did mention to you that there are a lot of factors. Some
Mhm.
factors are inherently on the, I would say, aggressive side in terms of return
Mhm.
potential and therefore correspondingly higher on risk. So I would
Okay.
say factors like momentum, for example, or
Mhm.
alpha, these are strategies which will be on the aggressive side. So they will have
Okay.
the potential for generating higher returns, but at the same
Okay.
time, they could be more volatile. On
Mhm.
the other hand, there can be factors like, for example, low volatility or to
Okay.
some extent, quality. So
Mhm.
they might, be relatively less volatile. Return potential
Mhm.
is slightly lower when compared to momentum and alpha kind of strategies, but
Okay.
they could have better downside protection, right?
Okay.
So now, if you take, let's say, a momentum and compare that with, let's say, a multi-factor, and let's say these two factors are quality and low volatility, right?
Mhm.
So, in this case, the single factor momentum will still be higher on risk return vis-a-vis
Okay.
the other strategy where you're combining quality and low volatility. So, one
Okay.
cannot make a blanket a decision based on
Okay.
whether it is one factor or two factors.
Mhm.
You need to
Mhm.
essentially look at what those factors are
Mhm.
and what they bring to the table in terms of
Mhm.
potential return and
Mhm.
how could they address the risk part.
Mhm.
So
Mhm.
one needs to go through that rather than
Mhm.
take decisions based on whether it is single factor or multi-factor, etc.
Mhm. Mhm. Arun, what happens if you have selected, say, for instance, the quality on the basis of quality, a few stocks in your smart beta index fund, but there's an issue of governance or the earnings have been impacted because of the one-off impact. So, does the rebalancing happen then, or you wait for 6 months period and then the rebalancing happens?
So, first of all, the rules will be set forth, right? For example, quality
Mm-hmm.
looks at the consistency of EPS. It looks at debt equity ratio. It looks at ROE. So all these factors, and it could have different weights. Maybe one third weight for each, and
Okay.
it will
Okay.
have those factors upfront
Mm-hmm.
decided. Based on that, whichever stocks are featuring, whichever
Mm-hmm.
stocks are coming in to the portfolio, that is how it will be. It will be
Okay.
reviewed after 6 months. But in the meantime, if something happens, the index will not make any changes. We'll wait for the rebalancing period. That's part
Okay.
and parcel of
Mm-hmm.
and that's again the difference. Sometimes there can be false warnings.
Yes.
Active fund manager could immediately decide move out,
Mm-hmm.
only to realize that the stock actually from there on it's starting to move up. So
Okay.
passive investing simply
Mm-hmm.
replicates. So something which happens, there's no subjective call, there's no a decision making in the meantime. So you just
Mm-hmm.
have to simply follow uh, the the index. So
Mm-hmm.
that's a big difference. In fact, that is also liked by a lot of investors, saying that you set
Mm-hmm.
about to doing certain things, you keep on with it, right? So
Mm-hmm.
that's how it.
Mm-hmm. So, what percentage of your portfolio should be allocated to smart beta indices? Does it again depend upon the risk profile of a person?
Yeah, so see, one is the smart beta space itself is very large. As I told you, there are different
Mm-hmm.
factors,
Mm-hmm.
and these different factors could work at different points in time, right? Like for example, momentum and alpha kind of strategies could work in bullish markets, for example, right? They will work much better in bullish markets where markets are having a momentum and, that works. Something else like a low volatility quality could work in different conditions. For example, if you are entering into a stage where there is risk aversion within equity, you still want to be there, but you want to be slightly risk averse. Those are times where low volatility, quality, etc., could work well, right?
Okay.
So investors also can use these strategies tactically to, at some point in time, make allocation to momentum, then later on to move to something else, depending on market context and their assessment. That's one way of looking at it. Second is that they can also make long-term structural allocation using these indices. Like, for example, we noticed that momentum as a strategy, while I did mention to you that it tends to work well relatively in bull markets and not so in slightly different market, difficult markets. But over a period of time, we noticed that as a strategy, it has done well more number of times than not. So, which also gave an impression that this could be the short-term volatility, notwithstanding, if investors understand they have the appetite for it, maybe it could be a good long-term, uh, fill it, shut it, forget it kind of long-term strategy as well. So
Okay.
it again depends, and again one cannot put a number to it. You'll have to look at whether you're making a structural strategic allocation, in which case you need not keep changing. Are you making these allocations for tactical calls? And therefore, you can decide how much to invest at various points in time. But having
Okay.
said that, it's good to have these portfolios, these kind of strategies. One, they offer a lot of uniqueness, which you will generally not find in other strategies. The portfolios are managed very dynamically because it's rules based. You will not have the biases sometimes that human fund managers could have, saying, look, I invested in this particular stock, about a year back I invested 6-7%. How can I make it zero now? What is it that has changed in this stock? So those kind of uh, the biases, those kind of decisions are not there in the index fund. It was working at that point in time, therefore it was there in the index. Now it is not there, and therefore
Okay.
the portfolios tend to be very different, therefore unique from generally what you could have. So again, as I said, the smart beta space is very large. You have a variety of strategies there, like single factor, multiple factor, and these factors could work at different points in time. So investors have a choice of using these strategy indices. Even tactically, somebody can say that, look, this market condition looks to me like momentum could work well, or
Okay.
we are entering into a stage where I think low volatility could work well. And
Mhm.
likewise, you can increase or decrease allocations to different strategies. This is one way of looking at it. The other way
Okay.
is these strategies can also be used for
Mhm.
long-term structural investments as well, as part of
Okay.
your core portfolio, right?
Mhm.
Some of these strategies, for example, momentum, even though it
Mhm.
might give an impression that it may work only in certain market conditions, when we
Right.
actually looked at the data, it had worked in
Mhm.
many times, most number of times than not, which could give you an impression that this could be a good all-weather long-term proposition. So if you're not really perturbed about near-term volatility, if you can withstand that, this could again be a good long-term strategy, right? So to
Mhm.
that extent, the allocations could be higher. And the
Mhm.
last point is that these strategies, the smart beta strategies, offer an element of uniqueness. Uh,
Okay.
Generally, the kind of portfolios you will have, you will
Mhm.
not find them in the actively managed side. And
Okay.
portfolios tend to be very dynamic because
Mhm.
every 6 months or depending on the strategy, whenever the rebalancing happens, sometimes the portfolios undergo so much changes that
Mhm.
the portfolios get refreshed. So
Mhm.
to that extent, the uniqueness, the differentiation again can be something which can add to your portfolio. So
Mhm.
I would not put a number to it saying this is how much you need to invest. Uh,
Okay.
so this again will depend on what exactly you want to do and
Mhm.
your understanding, your assessment of those strategy indices and the funds themselves.
Mhm. Mhm. Nicely explained, and it seems to be a smart strategy to really invest in smart beta funds. Thank you so much, Arun, for your time and in-depth explaining us how smart beta funds really work. Thank you so much.
Thank you very much.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.